We also want to welcome in Art Hogan III, Managing Director and Chief Market Strategist at National Securities. Art, thanks so much for being back on the show here with us today.
Thanks so much for having me.
Unfortunately, my co-host is having technical difficulties, Jeff Small, in his studio, so it's going to be the two of us. But that's okay because I've accomplished more in the last 47 months than Jeff has in 47 years. A little political debate humor. It's been so long since we had you on the show, well before the COVID crisis. So tell me, what has surprised you the most about how the markets or the economy has reacted to this, to all the COVID-19 stuff?
Yeah, it's been an amazing year. 2020 will be a year that none of us will soon forget. And I think that the interesting part of this year was we started out with a market that was looking like it really wanted to chug higher. And as you remember, the first couple of months of the years, we were putting in all-time highs almost every other day. And so this is a market that was on very good footing with an economy that was very strong. Unemployment was very low. Expectations for earnings were very high. And then out of the blue, in February and the beginning of March, we realized that this COVID-19 pandemic was going to hit our shores, and we just didn't realize just how much of a change to our lives that was going to be. So we actually had a market that set some records pretty quickly from going from a bull market to a bear market, the fastest we've ever seen that in history. The 40+% drawdown in the S&P 500 happened at record pace. And at the lows of the market around March 23rd, the news was getting worse, not better, but the market, being a forward pricing mechanism, stopped there and started looking ahead. And the most amazing thing to me right now is how confusing that is for everyday people to understand that how can the market be doing better than we are? How can the market be climbing here? And clearly the news we're getting is getting much worse.
In fact, it was around the middle of summer that you actually gave the advice of having your equity portfolio be well balanced and sticking to your long-term plan regarding your investments. So is that still your advice? I mean, that's turned out to be pretty good advice since midsummer, right?
Yeah, it certainly has. It's actually, we've talked about that at the beginning of the year. And one of the things we really stressed, and this continues to be our game plan, is that you want to have, let's say your average portfolio, you and I have a portfolio that's 60-40, and that means 60% of our assets are going into equities, 40% are going into fixed income. And in that equity portion, we really want you to have a barbell approach where on one end of that, you have growth. And that growth can be expressed in many different ways, but it's exposure to those names that have really helped us through this pandemic, those mega cap, fast growing technology names and some of the healthcare names. On the other end of that barbell, we wanted you to have cyclical exposure, economically sensitive cyclical stocks. And then we want you to rebalance that every 2 months. So in a sense, what you're doing is you're investing in what's working now while the pandemic's going on, and you're investing in what's going to work when the pandemic is over. Every 2 months, you're selling those stocks that have done very, very well because they're what's working, and you're investing in the stocks that haven't done it very well to keep that balance. And if you look at that 60-40 portfolio throughout the course of this year, you're far ahead of the S&P 500 in terms of returns. And I think that approach is going to help you throughout next year as well. As we get to the other side of this pandemic, you're going to see that cyclicals are going to get rotated into economically sensitive stocks like the financials and the industrials and the materials. All of those will do better as the economy starts to improve and we have things like a vaccine and better therapeutics.
You know, it's funny, over the last several weeks, you know, it's been a false start when it comes to those cyclicals. We've had some days where the tech stocks drop, the cyclicals make a little bit of a run, and then all of a sudden it goes back to the tech stocks again. So the market is trying to make that rotation. In the minute we have left in this segment, tell us, you know, best guess. I know you really don't know, nobody has a crystal ball, but when do you think that rotation to the cyclical stocks paying off is likely to happen?
My guess is we're going to probably see that pay off as we head into post-election timeframe. Then we'll have some readouts on some of those vaccine candidates. We'll have a vision that the first half of next year will look a whole lot better than the first half of last year. And I think that market being in front of that is going to start to sponsor some of those cyclicals and probably start to pull back on some of those technology stocks that have just been unidirectionally higher over the last 5 months.
Mm-hmm. I have to tell you, you know, I give you a lot of credit. It looks like you're working from home. And all I have to say is that if I had a sofa that comfy and I had to try to get some work done, I don't think I'm man enough to do it. I'd probably be snoozing half the day. So I give you a lot of credit for that. We take a commercial break. Stay with us if you will. We'll be back in a moment. And you stay with us too. We have much more coming up in just a moment on the income generation. We'll be right back. Right now, it's time to bring back Art Hogan, Managing Director, Chief Market Strategist of National Securities. So Art, if you think that rotation is going to come at some point shortly after the election, then is your best advice that this volatility that we're likely to see over the next month or month and a half or so leading up to the elections, or maybe even leading up to December by the time we find out who the next president is, when all the votes get counted, are you a proponent of buying the dips on this volatility during this lead up to the elections?
Yeah, buying the dips and timing the market's very difficult for the average investor. So if it's if it's necessarily your job to trade on a daily basis, that's a fine attribute to have, and buying the dips has certainly worked. If you're a long-term investor with long-term investment needs, I would say stay the course. I want you to have a diversified portfolio, and I want you to rebalance. And when you rebalance every couple of months, you're going to sell some of those winners to get that back down to your original level, and you're going to buy some of those losers. And at the end of the day, that's going to give you the right exposure for that rotation into cyclical. So buying the dips if you're a trader, and stay the course, and continue to rebalance if you're a long-term investor.
Oh, good advice. There's a big difference between long-term and trading for sure. So today, of course, on the show, as you know, we're talking about inflation. And a lot of people are worried about inflation because of all the stuff the Federal Reserve is doing in terms of stimulus, printing money. But the reality of it is we had a lot of that also really over the last decade or so in, pretty much the Federal Reserve stood on its head and could be spitting nickels as far as we know, and they still couldn't manufacture inflation. So do you think all of a sudden we're going to start seeing higher rates of inflation, or do you think our bigger enemy's deflation potentially in the years to come?
Well, I would tell you this: a global pandemic, is clearly a deflationary event. There's two types of inflation, and one is demand pull, and the other is supply push. And demand pull just means how much demand is there for all of the goods and services around the planet. And right now, there's not a lot. The economic activity is obviously impaired because of the pandemic. So we're in a deflationary pandemic right now, but coming out of that, there's likely to be a burst of economic activity with all the pent up demand for the goods and services that we couldn't consume while we're at home. So I will tell you the second thing to think about in terms of what could cause inflation, and on the supply side, the causes could be we've gotten more protectionist as a country, and we're seeing that every day with the technology cold war we're in with China right now. So having to change supply chains and move those around, and get things from other places as we continue to battle China over trade, and that's going to have a cost to it. So the supply side could actually start to see some cost. If we're going to be a less globalized or less global economy, that would certainly come with some cost. On the demand side, I certainly think that demand side is going to be impaired until the second half of next year. So that balance between the demand pull and supply push probably is kept pretty well in check. I would suspect, though, that as we work our way into 2022, we might have a vision where things have improved enough, and there's enough demand for goods and services, and wages start to slowly rise, and that continues to become a self-fulfilling prophecy. That yes, with the full amount of monetary policy globally, there could be a potential for inflation. I just don't think it's the next 12 months. So if you're concerned about inflation, I would say that I would put that concern over here and start thinking about that at the end of next year.
So do you think then there's a bigger threat of continued asset inflation, which is really what we've seen, after the financial crisis? Not so much inflation as we think of it in the textbook sense, but we've seen this asset inflation with real estate costs, with in fact, we're seeing that even now, right, in the real estate market, and we're seeing that now in the stock market rebound. So do you think there's more of a chance of that happening, as happened over the last 12 years or so?
Sure. And the assets obviously are going to be inflated in a low interest rate environment because they're the alternative, right? So if you and I need to have a return on our investment dollar and we can't get it if the US 10-year is yielding 70 basis points, we're gonna be willing to pay more, right? So we're gonna be willing to pay a higher multiple for equities. And that's been true for the history of Wall Street. So clearly, if in fact that safety trade or the yield on the US 10-year were more normalized in something like 3 to 5%, which is its historic average over the last 50 years, then equity valuations would have to come down. And there's a ratio there, right? So I think that's one thing. I think real estate's a whole different department of inflation right now. And what's going on in real estate, which is amazing, and the strongest part of the U.S. economy right now, is that there's two populations going after the same product that we don't have enough.
And we have 20 seconds left, Art.
Housing is I think is very robust right now. I don't think those valuations are elevated. We just don't have enough homes in our country.
And I think people are working from home. They want to work from the nicest home they possibly can and enjoy it if they're going to be stuck there. Art, thanks so much. Your home is certainly very nice, that comfy couch. Hope to have you back. And you stay with us. We have more coming up in just a moment right here on The Income Generation. We'll be right back.